Borrowing capital, it's essential for farms, and it helps to fund everything from inputs to the land. And while it can come with a number of risks, there's a method to harvest success without sacrificing the farm. Roger McEowen's with the Washburn School of Law joins us now for a closer look. Thanks for your time, Roger. You know, this method referred to as low-risk credit farming. Tell us more about that.
Well, good to be with you, Tony. Basically, what it is the disciplined pursuit to try to maximize your financial leverage while minimizing the exposure of your core, what I would call irreplaceable farm assets. So it's a shift from a reactive debt-fueled strategy to a proactive equity building approach.
So really understanding that credit landscape, it's kind of a concept of risk versus reward, I would imagine. So how does that play into the method?
Well, a low-risk borrower has to know what their net worth is, and I would say down to the dollar, and understand that the balance sheet is your ultimate defense. And of course, the true measure of financial health is often the working capital. That's your current assets minus your current liabilities. And so if you've got a strong working capital position, that's going to allow the farm to cover unexpected expenses and service debt, even during a poor crop year, without selling long-term assets. And of course, ag lenders often consider a farm that has a debt-to-asset ratio of 30% to be in a pretty strong position. That's really considered strong in the ag lending industry. And the major factors, of course, that influence that ratio would be land values and interest rates.
You know, I'm thinking on that debt side, there is the principle, there's good debt, I guess, and then there's bad debt. So help us kind of work out the difference there.
Well, good debt pays for itself, and it increases your equities. So, for example, if I take out a loan, an operating loan that funds my inputs, such as my seed, my fertilizer, my feed, that directly generates revenue with the current crop cycle or my livestock cycle. I'd call that good debt. So, and same thing for a loan that's used to acquire land with a return on investment that's higher than the interest rate, plus a loan for example, an equipment loan that reduces labor costs or increases harvest efficiency enough to justify the annual ownership cost. I would also call that a good loan. But on the other hand, bad debt would be any debt that would be, for example, for items that are going to depreciate rapidly and don't directly increase my revenue. That would be consumer purchases, non-essential farmstead improvements, or overspending on customized niche equipment. Low-risk borrowers aggressively avoid that category.
So are there any additional financial and physical strategies that are connected to that low-risk method?
Yeah, I think so. I think one primary one for farmers is crop insurance. That's a critical piece of providing revenue protection. And basically, it's essentially a guaranteed line of credit from a third party in the event of failure. I think that's the way you want to look at crop insurance. So you should always select on your crop insurance a coverage level that at a minimum is going to cover your operating loan and all your scheduled debt payments. And that, I think, is non-negotiable for low-risk credit farming. And also, you got to protect against yield risk. And so implementing designed and disciplined marketing plans using tools like cash forward grain contracts, futures options, understanding the commodity markets, that's going to reduce your exposure of the farm's expected crop revenue to market volatility. And of course, diversifying your income streams. Don't just be a crop operation. Don't just be a livestock operation. Have a mix of both, because when one is down, the other one's typically up, and vice versa. And that's what we're seeing right now.
Roger, great to visit with you. Thanks for the insight. Roger McEowen's with the Washburn School of Law.